This isn't about Bitcoin dropping below 65K. It's about something way more important. An institutional crypto firm just halted withdrawals during a market slide. And when redemptions stop, volatility stops being the story and liquidity becomes the story. Guys, BlockFills, BlockFills, a Chicago-based institutional trading and lending desk, has suspended client deposits and withdrawals. Trading remains partially operational. But when capital can't exit freely, confidence will reprice fast. And by the end of this breakdown, guys, you are going to know whether this is a contained liquidity pause or the early stage of broader counterparty stress. Also, in minute 3, I'm going to show you the signal institutions watch before contagion spreads. So here's what we know. BlockFills cited recent market and financial conditions. Makes it sound pretty, right? They cited that as the reason for temporarily suspending deposits and withdrawals. And BlockFills serves institutional counterparties, if you're not familiar with them, hedge funds, digital asset managers, and liquidity providers. They've not disclosed any solvency issues. They've not provided a timeline for restoration. Meanwhile, Bitcoin dipped below 65K. Roughly 396 million in leveraged positions were liquidated in 24 hours. And Ethereum and XRP both also roughly fell 4%. And that sequence is not random, because when leverage unwinds into thin liquidity, balance sheet stress surfaces. So here's the core thesis. This is not automatically 2022 again. We're not back there. But withdrawal freezes are never neutral events. They expose funding structure. And funding structure determines whether volatility stabilizes or accelerates. So why do these freezes matter? Well, during the 2022 crypto winter, platforms like Celsius, Voyager, BlockFi, and Genesis froze withdrawals before filing for bankruptcy. Each cited market conditions. Sound familiar? And each framed the pause. It's temporary, guys. It's temporary. Nothing to see here. But what followed, guys, was liquidity mismatches that had been building for months. And now there's no public evidence that BlockFills is insolvent. All right? I'm not saying that. But history teaches us a simple lesson. Withdrawal suspensions occur when liquidity timing doesn't align with redemption demand. And in crypto, there is no lender of last resort. There's no deposit insurance. And liquidity must be managed internally. Because when volatility spikes, collateral values fall. And if a firm extends credit against crypto assets, margin calls can accelerate quickly. And when redemptions outpace available liquid capital, firms have no other choice but to pause. That is structure, not drama. So what triggered the stress? Why did they have to freeze the deposits and the withdrawals? Well, Bitcoin's pullback below 65K wasn't catastrophic, but it occurred in an environment of thinner order books and rising macro uncertainty. Liquidity depth across exchanges has been lighter, right? If you look at the numbers, you can see that. And then when that happens, spreads just widen faster. Large orders move markets more aggressively, and nearly 400 million in liquidations occurred. Repricing of rate expectations, add that to the fire. Regulatory uncertainty, and now you have the ingredients for short-term funding pressure. BlockFills operates in crypto-backed lending in institutional liquidity provision, and those businesses are directly sensitive to volatility. So when funding markets tighten, liquidity desks feel it first. The next part, guys, is what institutions are watching extremely closely regarding this story. And it's not price. It's not social media reaction. It is settlement behavior. Because in 2022, contagion spread because redemption friction appeared across multiple venues. Delays increased. Spreads widened dramatically. Stablecoins briefly traded off peg. If those signals appear simultaneously, stress becomes systemic. If they don't, events remain isolated. And right now we are seeing volatility. we're not yet seeing widespread redemption gridlock. And that distinction really matters. Because at a macro level, crypto no longer trades in isolation. Risk-off sentiment in traditional markets, think stocks, right? Selling Nvidia, whatever. So risk-off sentiment in those traditional markets feeds directly into digital assets. We've seen an 80% correlation between Bitcoin and the NASDAQ. And when interest rate expectations shift, leveraged positions start to unwind. When yields rise, speculative capital contracts. It just dries up. Volatility in crypto today is partially a reflection of broader capital tightening. Thin liquidity puts macro repricing equals amplified downside moves. But amplification is not insolvency. And markets often confuse the two. So guys, in times like this, we need to start thinking about self-custody. Because events like this surface a recurring lesson. Crypto was built on self-custody. Sure, during calm markets, convenience can dominate. During stressed markets, custody discipline returns. It's not a call for panic. It is a structural reminder. Centralized platforms are efficient execution venues, but they're not long-term vaults. Institutions diversify custody exposure across multiple providers. They separate trading liquidity from treasury storage. Serious participants treat custody as risk management, not ideology. So again, if you don't control the keys, you're relying on someone else's balance sheet. And that has always been true. Volatility makes it visible. So we have to ask ourselves, with this recent event, is this 2022 all over again? The structural landscape is different from 2022. Retail yield products are less dominant. Leverage is more concentrated among professional desks. Balance sheets face more scrutiny, and that reduces retail contagion risk. But it increases short-term derivatives volatility. Guys, things are getting so complex now. We've got derivatives, we've got spot, we have all these different providers. Any little hiccup anywhere can cause massive problems. And the real question across all of this is duration. If withdrawals resume quickly and transparency improves, markets stabilize. If silence persists, counterparty risk reprices aggressively. And repricing in crypto, it is swift. It can happen like that. Because confidence is the only backstop. So what do we watch now? We've seen it. We saw the deposits and the withdrawals freeze. What next? 3 indicators are going to determine trajectory. The duration of the withdrawal suspension, the stability of inter-exchange settlement flows, and stablecoin redemption integrity. If those remain stable, this event becomes a contained liquidity pause. But if redemption friction spreads across unrelated platforms, volatility will escalate. So keep an eye on funding rates. Watch the spreads. Watch settlement speed, because price follows liquidity, not the other way around. So guys, this wasn't a price story. It was a liquidity test. Another crypto firm halting withdrawals during a market slide reminds participants that counterparty risk never disappeared, but it does not automatically signal collapse. It signals stress, and stress reveals structure. Disciplined investors don't react emotionally. They reduce unnecessary exposure. They separate trading capital from long-term holdings. They monitor liquidity indicators, not headlines. If this remains isolated, sure, markups will absorb it. But if redemption friction spreads, risk will reprice rapidly. In crypto, volatility is common. Liquidity failure is rare but decisive. Guys, if you want the deeper breakdown of how tightening macro liquidity conditions are feeding directly into digital asset funding markets, the next analysis connects that framework. Because in this cycle, crypto doesn't move independently. It moves with capital. And capital follows liquidity. This is Luke with Ledger Prime. Till the next one.